I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago.
The one risk I'm really worried about is liquidity risk, and we're starting to see markets locked out of funding.
We need a resolution of the Ukrainian situation, and we need more stable energy prices.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine Lacqua. Here's what's coming up on today's program. Recession risk. Growth concerns weigh on sentiment. Former Treasury Secretary Larry Summers says a recession could hit by year end. Energy crisis. German unions warn the country's gas crunch could wipe out entire industries. Chancellor Olaf Scholz signals a Lufthansa-like bailout could be in store for gas giant Uniper. Plus, summer of strife. Walkouts and personnel shortages hit travelers across Europe as workers announce more action to come. U.S. flyers don't escape unscathed either over the July 4th weekend. Well, happy Monday. Happy 4th of July if you are in the U.S. And with that in mind, it is certainly a lower volume day here in Europe where markets are indeed open. Just a reminder, we won't have cash trading of U.S. equities. We won't have cash trading of treasuries, either futures. Of course, we'll still be trading European stocks up on the front foot this morning, up 0.6% to start the week. Perhaps that's because we don't have treasuries trading. Yields have really been dictating the pace of equity market moves. Last week, falling by 25 basis points for the 10-year yield, the biggest gain in bonds and bond prices since March of 2020, just showing you the reversal we've seen and perhaps this concern of a slowdown of a recession. To that point, iron ore falling nearly 5% this morning. Goldman Sachs downgrading their price target for iron ore. They say in the short term, it could get to $90. They say longer term, it could be $100. They're concerned because we have all this excess supply, and at the same time, China housing potentially slowing. Of course, China is attempting to fully reopen. Bloomberg dollar spot, not a lot of action this morning. Again, perhaps a given since we are on the July 4th holiday. But there is some action in Bitcoin, slipping below $20,000, getting very, very close to $19,000, down 1.6%. Of course, when U.S. markets are closed, Bitcoin is usually open on the weekend as well, so perhaps a good reflection of sentiment this morning. Let's get a check on your map, see what the wider European story is doing. Again, it is mostly gains for this European session this morning. Most of the gains coming through from the UK, up nearly 1%, one of the stronger performing regions. That's because a lot of the oil and gas giants, they're doing the best today. Energy, the best performing sector in the Euro Stock 600. Meanwhile, we're looking at Germany's DAX, among the worst performing. Of course, Uniper sits there. Some concerns there about will they need a bailout. They've, of course, last week withdrew their forecast for the whole year, given that Russia's cut off about 60% of gas flow. Kakaron up 0.6%. Also, little bit changed, just up about 0.2% just for the IBEX and the FTSE MIB. Well, to that recession story, where former Treasury Secretary Larry Summers sees a rising danger of recession in the U.S. before the end of the year. Take a listen.
Yeah, I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago. Look, David, we've got the first quarter numbers in the bank. They are negative for GDP. There are many forecasters who believe that the second quarter, which ended yesterday, also had negative GDP growth. It's not really the formal definition of recession, but people often say it's a recession when you have 2 quarters of negative GDP growth in a row. And there's, I think it's probably close to a 50-50 chance, maybe it's a bit less than that, that we've had 2 negative quarters in a row. So I think you have to say that the chance that a recession is ultimately dated as having begun during 2022 has gone up significantly.
Larry Summers there talking about the rising risk of recession, something that's certainly been on everyone's minds. Of course, one of the big questions is to what degree has this market priced in recession? When you look at equities in a bear market, stocks in the U.S. falling more than 20%, now the conversation seems to have shifted. Not just is it equities pricing in a recession, but is it earnings we're going to need to be worried about as well. And of course, you're not seeing that reflected at the moment in stocks. We are seeing a gain, as I was saying, in the European stock 600, up 0.7% this morning, but volumes are low. When will bad news start to translate to bad news again? Some of the weaker data that have been coming through, we've seen stocks rally as yields fall. Well, let's try to digest what this environment we are trading in at the moment. Joining us now is Trevor Gretham, head of multi-asset at Royal London Asset Management. Trevor, let's start here. Your investment clock, which I'm sure is a fancy, perhaps algorithm-based investment thesis, is stuck in stagflation mode. You talked about it's been that way for the last 6 months. What pushes it from stagflation to recession, Trevor?
Yeah, the investment clock's very simple. All it is describing the business cycle in terms of growth and inflation. Those are the two things that matter. And where we've been for the last 9 months is stagflation. That's been the word on everyone's lips. Slowdown with rising inflation caused by, amongst other things, the supply distortions of post-COVID recovery and the Ukraine invasion. The next stage we should expect is where inflation drops, but growth is still weak and in fact could be getting weaker. And that's when the interest rate rises we've seen from the Fed and other central banks take effect. So we call that reflation. And we might be pretty close to that. So commodities have been quite weak in the last month or so. Metal prices in particular, very weak. And what happens with commodities is they get squeezed higher up very tight supply-demand curves, but they come down just as quickly when demand drops sufficiently. So that's the next stage we're expecting. But for stocks, it doesn't necessarily mean good news. Bond yields could be falling, yes, and that in theory helps valuations. But as you pointed out in your introduction, the earnings recession is coming next. And stock markets overall in a recession don't tend to find their floor until unemployment peaks, and that's maybe a year or more away.
How far are we from pricing in a fall in earnings into this equity picture?
Well, I don't think we are, because you can explain everything that's happened in the last 6 months through valuations. So if you look at the UK stock market, for example, it's hardly dropped at all. It's full of value stocks. But if you look at the US stock market, it's had a bear market led by the FANGs, the highly rated, interest rate sensitive sectors. So what we've seen so far is an adjustment of valuations to reflect higher real interest rates, but we haven't yet had an adjustment of share prices to reflect weaker earnings. And that's quite normal. The stock markets don't tend to process the future until it happens. And if you're expecting the Fed's interest rate rises to result in a recession, as Larry Summers is saying, then at some point they'll have to ease policy, and then you have to wait for those rate cuts to take effect before unemployment rates peak. And that's why in the last Fed-induced recessions, if you go back to 2007-8-9 or 2001-2-3 or even 1989 to 1991, it took about 2 years, possibly even 3 years, for a bear market to end, and we've had 6 months.
You mentioned UK stocks, full of value stocks. Perhaps that's been helping them in this environment. Trevor, we've heard from Bank of England's Catherine Mann, for example, a couple weeks ago, talking about the weak pound, the issues there. When you look at sterling continually under pressure, again, much of that coming from a stronger dollar, what impact should that be having on UK corporations? How should we be interpreting that into this equity market?
Well, the UK stock market is not the UK economy, and about 70% of its earnings are derived overseas. So if you've got a devaluation in the pound, those overseas earnings get immediately inflated. It's also a stock market full of resource sectors which have done quite well during stagflation. The next stage of the bear market we think could be tougher for the UK. I wouldn't be surprised to see the UK stock market drop. But it should still be a relative outperformer because the valuation is still very attractive. You know, on a long-term case Shiller, well, I should say Shiller-based PE, the UK is roughly at its 30-year average, whereas the US got to a level where it's the most expensive it had been since the dot-com bubble. So you've still got value there in the UK, but it might just be value that softens a bear market rather than avoids a bear market.
And Trevor, we'll certainly get more into the energy picture in just a bit. But in terms of your sector outlook, given this environment which you're preparing for, this change in regime we've seen and the continual change, where is the place that you look most towards safety? Are bonds, yet again, there is no alternative for equities. Is that picture gone? Are bonds attractive, again, as the port in the storm?
we're getting there. So we've got commodities in our multi-asset funds. So that's been the area we've been overweighting for the last 6 months. We've been underweight technology and consumer discretionary sectors, which are most sensitive to rising interest rates. We've been underweight bonds. Where I see us going next is probably overweighting government bonds and overweighting the more defensive sectors like consumer staples and utilities. So it could be both the growth sectors and the value sectors could suffer in the next stage. But it's not a given. It's possible that as bond yields drop, people say, well, technology is a long-term growth story. The valuation basis is improving. And people may go back there, but I suspect from long experience that in a recession, some of those growth stories lose their luster a little bit. Do you really need to get an upgraded smartphone and a new electric car in a recession? You could leave it a few years, couldn't you? So I suspect the valuations will still come down there. So it could be bonds, gold might become attractive potentially, and defensive sectors. That's where I think we're headed.
Trevor, as someone who took an embarrassing long time to get an iPhone with the Face ID thing on it, I probably fall into that camp of being very willing to wait. Well, what is your tech sector outlook at the moment then? I mean, because look, typically you say, okay, in an economic cycle, tech does well, costs are very low, not as tied to the cyclical parts of the economy. Is that still going to be true this time if recession is on the horizon?
I think there'll be a real distinguishing going on at the stock and individual subsector level. So some parts of technology are what I would call, it sounds like a contradiction, I would call them growth cyclicals. They've got long-term growth, but they're also economically sensitive. Think something like semiconductors. So those areas in a recession you'd imagine won't do too well. But there's other parts of tech that have become almost like utilities. And maybe some of the sort of software providers have got these regular repeat earnings, which make them a bit more like utilities. So I can see some sort of differentiation going on within the sector. Overall, it's quite hard to have a blanket view. And again, my experience, having worked in investment banking in the late 90s, early 2000s, is a lot of long-term growth stories just hit the buffers. And bear in mind that 2001, 2, 3 bear market, it was falling bond yields the whole time, and tech was underperforming. So I think the valuation starting point isn't helpful for tech.
Yeah, and into your semiconductor point, Micron certainly not a comforting sign last week, warning on their earnings. Trevor, really great to have you on the program this morning. Trevor Gretham, head of multi-asset at Royal London Asset Management. Well, coming up on the program, a stark warning from the head of German unions. Cuts in Russian gas supply could result in the collapse of entire industries. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Let's get to some of our top stories today with the Bloomberg First Word News. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny, and happy Monday. Ukraine says it has pulled its troops from a strategic city in the Luhansk region, confirming Russia's claim of the seizure. The gain takes Russia a step closer to its goal of controlling all of the Donbass region, comprising Luhansk and Donetsk. Ukraine's armed forces say the order to withdraw was made to prevent heavy casualties. Now, the British Chambers of Commerce says more UK firms than ever are expecting to raise prices in the next 3 months. Their latest survey says 3 in 4 firms have no plans to increase investment, and more than a quarter now predict a drop in profits. Meanwhile, the Resolution Foundation think tank says disposable incomes among UK households grew just 0.7% annually in the 15 years before the pandemic. The European Central Bank is exploring ways to prevent banks from earning windfall profits from the subsidized lending program it launched during the pandemic, once it raises interest rates later this month. That's according to the Financial Times, who cited people familiar with all those plans. The ECB's Governing Council is reportedly planning to discuss how to curb the extra margin banks could earn by placing them back on deposit at the central bank. Danish police say a gunman has opened fire in a busy shopping centre in Copenhagen, killing 3 people and critically wounding 3 others. A 22-year-old Danish man has been arrested, and there's no indication that anyone else was involved in the attack. Police are still investigating. Gun violence is relatively rare in Denmark. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Leanne Gerrans there. Now to Germany, where the top union official has warned that the country's industries could face collapse because of cuts in the supplies of Russian natural gas. This all comes as Chancellor Olaf Scholz says the government is continuing talks for aid for gas giant Uniper. For more, we're joined from Berlin by Bloomberg editor Benedict Kamel. So, Benny, we have this warning from the German Federation of Trade Unions. What is he warning about? What industries could potentially collapse?
So the industries that are most exposed here are obviously the energy-intensive industries. We're talking about aluminium smelters, we're talking about cement plants, we're talking about glass, we're talking about the chemicals industry. So anything that needs a lot of gas, a lot of electricity, a lot of power generally to keep things going. And the warning as such might not be new. We knew that this is an issue facing the industry. I suppose what's different here is sort of the tone that she strikes. She says this could lead to a permanent collapse. So not just sort of a bit of a bump in the road for these industry, but really a permanent lasting damage to the industry. The other side of this equation is obviously the consumer side. So the industry side, that's fairly well established what might happen in the worst case scenario. On the consumer side, she says we might actually face something like public anger, public outrage, sort of a public backlash, civil unrest, should people be confronted with bills that they simply cannot pay anymore. Anecdotally, the mayor of Hamburg said that we might need to get used to cold showers in the winter or in the next couple of weeks, just as our contribution to saving energy. So a lot of very unhappy people about this.
What's been the government's response to all this?
So the government is sort of racing against time at the moment. They're trying frantically to fill their gas storage sites, and this is the number that everyone is sort of intensely focused on at the moment. I imagine a couple of weeks ago nobody knew what gas storage sites were and what a full storage site constitutes and so on, and now this is the number that everyone's looking at. We're at about 60% now. They need to get to 90 plus if they want to have any chance of making it through the heating season, which kicks off in about 100 days, so it's not that far away. The other date to look at is July 11th. That's when Nord Stream 1, the big pipeline linking Russia to Germany, will go into planned maintenance mode for about a week, and there's significant concern out there, given everything that's been going on, that the pipeline won't spring back to life after that maintenance or at maybe very reduced flows. So there's a lot of concern right now what will happen after that date and what we can do to find alternative means or alternative supplies of energy. Norway's an option, LNG terminals, Qatar, and that's really what the government is trying to do right now.
Benny, thank you very much. Bloomberg's Benedict Kamel there on all things energy in Germany. Now, coming up on the program, another weekend, more flights canceled. We're going to take stock of the travel chaos around Europe. Hope everyone out there has been traveling okay. This is Bloomberg. Welcome back to Bloomberg Surveillance. Now, airlines and airports are preparing for significant disruption to schedules over the summer at a time when travel is starting to return to pre-pandemic levels. Let's get straight to Bloomberg's Laura Wright, who's been tracking it all. Laura, what disruption are we expecting this summer?
Well, industrial action is threatening to derail that long-awaited recovery that the sector was hoping for. The common denominator for these strikes is pay. Workers feeling their wages eroded by inflation. They want to be fairly compensated against a tough macro backdrop and at a time when demand is booming. To add to this, there have been a number of capacity cut announcements from airports and airlines, a sign that they are struggling to cope with normalized passenger numbers. For example, Schiphol Airport in Amsterdam will see a reduction of 20% this summer. For Gatwick and British Airways, the drop will be 11% and 10% respectively. The industry lost many workers over the pandemic. They found jobs elsewhere and are reluctant to return to a volatile sector. According to data from IATA, there will be a shortfall of 200,000 workers the end of this year compared to 2019 levels.
Asking for a friend who may or may not be traveling in coming months, what are going to be the consequences in the short and medium term, Laura?
In the short-term flight cancellations, my board shows cancellations per country for the month of June compared to June in 2019. Italy, the notable laggard. The US is the outperformer, showing the issue is less pronounced there. In the longer term, the key question, where will demand fall after the peak summer season, given the pressures of cost of living? Analysts trying to work out whether airlines are a bargain or relatively overvalued at current levels. Danny.
Laura, thank you very much. Bloomberg's Laura right there. Now, coming up on the program, as investors warn that the worst U.S. stock sell-off in half a century may not be over, what's the outlook for VC? We're going to talk to firm Antler's president, Ed Knight, to discuss. This is Bloomberg. Recession risk, growth concerns weigh on sentiment. Former Treasury Secretary Larry Summers says a slowdown could hit by year end. Energy crisis. German unions warn the country's gas crunch could wipe out entire industries. Chancellor Olaf Scholz signals a Lufthansa-like bailout could be in store for gas giant Uniper. Plus, summer of strife. Walkouts and personnel shortages hit travelers across Europe as workers announce more action to come. U.S. flyers don't escape either over the July 4th weekend. Good morning. Happy Monday. Happy 4th of July. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now to the markets, where the S&P 500 posted its worst first half in 52 years, driven by high inflation, growing fears of recession. Now, at the same time, venture capital firm Antler sees investors increasingly looking to private markets for returns amid the volatility. But the valuation crash of one of Europe's most valuable private companies, Klarna, which is down to $6 billion from $45.6 billion, indicated that startups might not be immune. Well, we're joined now by Ed Knight, president of Antler. Ed, let's not dive in headfirst to Klarna quite yet, because I know your exposure to perhaps to buy now, pay later is a little bit limited. But when it comes to VC as a whole, the turmoil we're seeing in public markets, how much of that has affected your world?
Well, I think that the big setback you've seen in valuations in public markets is naturally going to spill over into private markets. And we've already seen anecdotal evidence of some very significant write-downs in the later stage growth public markets, where valuations were up something like 9 times in the last 5 years. So there's some very significant valuation inflation in the later stage part of the market. So what we're seeing with these big share price falls has naturally spilled into private markets as well. And I think that's probably to be expected, given the parity between the two.
To what degree, though? Is it the same degree that we've seen in public markets?
Well, I think the example that you used just then is a very good example of that. So you've seen share price falls of 75, 80% in the last 6 months. We have to remember this only started in November. It's happened very quickly. And so, too, that's spilt over into the private markets, and probably the same order of magnitude.
Yeah, I do want to just mention buy now, pay later. I know in your holdings you have one that's not really retail oriented. It's more, supply, shipping, that sort of thing. But looking at Klarna taking this huge hit, I know you invest a lot in fintech.
Yes.
Given valuations have fallen for this space, is it interesting to you? Would you invest in a buy now, pay later, or does that highlight sort of the risk of this fintech area?
Look, I think if we look at the technologies which are fundamentally underpinning all of this innovation, particularly in fintech, we're really just at the very beginning of understanding the implications of this, and very early on in the journey. So, there will be business models which evolve. Some won't make it, some will make it, but they'll evolve from here. And so I think, as it would be the case in any type of investment process, you invest every year. Some vintages will be worse, some vintages will be better, but you either believe in the underpinnings of these technologies and where they can take us, and as it relates to legacy systems evolving into the 21st century, or you don't. And so I think that the fintech space, there's an enormous amount of financial services which are still operating the same ways they have done for the last 25, 30 years, which probably need updating. BNPL is one of those.
I see. So it's about going through this period, separating the wheat from the chaff. How difficult is that to do right now, coming out of a period where valuations were so inflated that people were just really willing to pay up to get exposure to these types of firms?
Yeah, I mean, I think that's exactly right. There was a sort of real frenzy, wasn't there, in the last couple of years of people trying to get money to work in what was perceived as a very, very exciting space. And of course, valuations reflected that, and we're now seeing a very natural setback. But if we look at the technologies of AI, machine learning, genomics, blockchain, battery storage, robotics, quantum, these sort of 6 or 7 key underpinnings, which are going to be such a big part of our lives over the next 20, 30 years, you're going to want to have exposure to them. And you won't know exactly what those successes will look like today. YouTube started as a dating app. We just don't know, but they evolve over time. It did.
That is something I did not know. That is fascinating. You mentioned blockchain. I mean, there's been some pretty spectacular, not necessarily blockchain, but crypto firms that have blown up, gone into liquidation, Three Arrows, hedge funds that invest in them. Are you concerned about this idea of a crypto winter where funding for these types of companies dries up?
I mean, again, it's very early on in the evolution of this, and there'll be people who know a lot more about this than me, but what I would say is that this is the mass migration of the world's finest mathematicians and computer scientists. I think that's worth paying attention to. And I think that if we recall what happened with the dot-com boom 25 years ago, there are echoes of that in what's happening now. Everything that had a dot-com attached to it just basically blew up and then blew down in the 2001-2003 period. So too, we're seeing the same thing now with anything which is crypto or blockchain related. My suspicion is that this is here to stay. And I think that, as I said, you write off the mass movement of these super talented, super ambitious people at our peril. It's perfectly natural after a mania that you're going to get a setback like this, but distributed ledger technologies look like they're here to stay.
In terms of direct exposure to crypto, how concerned are you there, considering Bitcoin trading around $19,000?
So we say $19,000, but we forget that this time 2 years ago, Bitcoin was, if I remember correctly, somewhere around $6,000 or $7,000. So it very much depends on your perspective. If you're unfortunate enough to buy at $60,000, then of course now you're feeling pretty uncomfortable. But maybe you were a person who bought earlier than that. You were bought at $6,000 only 2 years ago. We have to remember that it was very, very recent. So it depends a little bit on your vantage point, I think.
And more widely, when you're talking to founders, how much are you telling them to prepare for recession right now?
Very much so. It's absolutely front and center, which is, subscription-based models when there's less discretionary income because oil prices are higher, interest rates are higher, cost of putting food on the table is higher. Is that discretionary item maybe a net subscription or something like that going to be as sticky as you might imagine? So we advise all of our founders, I think as does the whole entire industry, to be very careful with their runway, to think hard about their projections, to be super careful with their costs, and to raise capital when they can, not when they need to.
Well, where are you targeting cost cuts? And more specifically, I'm leading a little bit here, but does it have to do with paying for compensation, with numeration, with hiring? Because, of course, it wasn't that long ago we had this huge push. You need to pay more. People are concerned. To very tight labor market, and now the cost concerns coming back into the picture.
I mean, we have to remember that these businesses are being built over a multi-year period. So it's very easy to look at 1 year in isolation and say that the costs are this or the costs are that when it comes to compensating individuals. But really, this is a long game, and these businesses get built over a period of time. Airbnb came out of, was it 2008, 2009? That was a long time ago. And it takes a period for the true valuation of these businesses to emerge. So I think you're always going to get year-by-year fluctuations in the cost of retaining your best talent. But the real key to this is the journey and seeing the perspective several years out.
What does the exit environment look right now for especially selling businesses to private equity? Is that still robust? Has that slowed down?
Difficult.
Really?
Yeah. I mean, if your valuations have come down as much as they have, then a lot of these stock option schemes are going to be underwater. Founders are going to be much less inclined to want to realize anything now. And that's why if you're in a position where you've got cash on your balance sheet and you've been careful with your business, then cash is king. This is a good time to be resetting your foundations and ensuring that actually the next opportunity of that exit, whenever it does come several years forward, you're going to be in the best possible shape.
All right, Ed, we're out of time, but I feel like that's a nice note to leave on anyway, away from the doom and gloom, pushing forward to the future. Ed, thank you so much. Ed Knight there, president of Antler. Now, coming up, don't let optimism among equity analysts fool you. Look, already back to the doom and gloom. Earnings forecast likely to be slashed as inflation and interest rates rise. That's not my view. I should say that's the view from our latest MLive Pulse survey. We're going to have that for you next. This is Bloomberg.
High inflation is probably worse over the very long term.
At this point, inflation rules the game.
That's why the Fed is committed to really curtailing the inflation. That's the bigger problem right now.
This risk of entrenchment where inflation fears are in your head and you just expect it to keep happening is elevated.
Now markets are shifting away from inflation worries.
I think it's recession risks.
Markets are not yet sure, so that's why you see this hick-hack going on in the markets, but actually we are at this tipping point.
I think recession's a bigger risk by now because inflation is priced in now, right? We're all aware we're in a high inflationary environment. People are adjusting their budgets, but recession's what's going to turn this market over.
I disagree on the recession risk in the United States, frankly. I think people are talking themselves into a tizzy here about a recession.
The recession-proof strategies that investors used in the last economic cycle, things like cash and high-grade bonds and treasuries, those just cannot be the strategies that you go full force into in a time when inflation is high.
Some of the respondents to our MLive Pulse survey this week. Amazon founder Jeff Bezos has criticized a tweet from U.S. President Joe Biden calling for oil executives to reduce gasoline prices. In a Twitter exchange over the weekend, the White House pushed back against Bezos, saying that elevated prices are, quote, not basic market dynamics. It's a market that is failing the American consumer. For more on this, let's bring in Bloomberg's Roz Matheson. Roz, what's going on here?
Well, as you said, there's been another Twitter dispute between Jeff Bezos and the White House. This one's really over the price of gasoline. And the suggestion from the White House is there's too much of a margin between what large oil companies are paying and what consumers are then paying at the pump. So basically suggesting a windfall gain for these oil companies. And of course, that's drawn the rebuke from Jeff Bezos, saying the White House either misunderstands economic policy or is trying to misdirect the problem away onto others. So it's basically an argument about who's responsible really for what we're seeing in terms of spiking inflation in the US. The interest, of course, of the White House is to say that it's not entirely the problem of the government either that caused it or in terms of how to fix it, and that these big companies need to play a part. And certainly a sign that that inflation battle in the US is really just heating up. And it starts that spat that began in May. Of course, there was a previous Twitter dispute between Bezos and the White House also over inflation.
Yeah, it's always remarkable to see these types of high-profile disputes happening just over Twitter, free for us all to see. I mean, Roz, look, of course it is very political for the White House when it comes to inflation, with midterms very soon on the horizon, but of course a lot competing for attention in U.S. politics. So how important will these inflation dynamics be for the upcoming elections?
Well, arguably, it's critical when it comes to these elections. Of course, as you note, it comes against the backdrop where the US president's popularity has been falling. The Democrats face a real risk of a wipeout in November where they don't control either house. And that leaves them very weak in the final 2 years of Biden's first term as president. And questions are rising already about whether he should or will even run again for a second term. And of course, you've got gas hovering around $5 a gallon. Still, that's very much sticking in voters' minds. And it comes against the backdrop also, not just of inflation, but a potential recession, warnings that the US might be facing a recession, and indeed the globe might be facing a recession. So if you put inflation and recession together, you've got really a political problem for the White House going into these elections, and then a multitude of other crises that he's dealing with as well. The war in Ukraine, obviously the recent overturning of the Roe versus Wade Supreme Court ruling, an outbreak of gun violence yet again in the US. So you've got all these things on his plate at the one time, and arguably not so much he can do on any of them fix them, limited ability to sort of influence the direction of any of these. And they're all going to come together in the run up to November. But inflation really is the one in terms of the economy that's going to very much stick in the mind of voters.
Roz, thank you very much. Bloomberg's Roz Matheson there. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Tesla's global deliveries dipped in the last quarter due to COVID shutdowns at its Shanghai factory, snapping a 2-year streak of gains. The automaker shipped almost 255,000 cars worldwide in the quarter that ended in June, missing forecasts. Tesla delivered a record 310,000 cars in the period before that. Now, Shimeo says it didn't pay a $1 billion offshore note that matured on Sunday, adding to a record wave of Chinese developers missing payments this year. The luxury builder said it also hasn't made payments for some other offshore debts, as in talks with creditors to come up with amicable solutions. If that fails, Shimeo says its creditors can take enforcement actions. Now, Japan's KDDI Corp says it's restored its mobile phone networks after a nationwide disruption over the weekend. Up to 40 million connections may have been affected, according to local media. The disruption also affected other platforms that use the network, like ATMs. The company's president said the situation was deeply regrettable. And the world's biggest oil trader, Vitol, says the global surge in fuel costs is starting to weigh on demand. Speaking on a podcast, Vitol's head of Asia says there's clear evidence that the high energy costs are causing economic stress and so-called demand destruction. The comments come after gasoline and diesel prices hit a record over in the US. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks very much. Leanne Gerrans here in London. While the war in Ukraine grinds on, the Ukrainian government and global policymakers are looking to the future. Switzerland is this week hosting the Ukraine Recovery Conference in Lugano in Switzerland. The aim of the meeting is to raise funding and map out the massive task of rebuilding Ukraine. For more on this, we're joined by Bloomberg's Maria Tadeo, who's at that conference right now. So, Maria, I know the conference, it's all about looking ahead, but talk us through the here and the now and the challenges that Ukraine are facing.
Yes, Danny, and that is the dilemma that a lot of these officials are facing today. By the way, this big conference put together by the Swiss government. They are, as you know, militarily neutral, but they do want to send this message that politically they have been aligned with the rest of the European Union in trying to help up the Ukrainians. Now, today we're expecting to hear from the Ukrainian president, Mr. Zelensky. He will use this as an opportunity to say, of course, Ukraine will have to rebuild itself after the war, but he also wants to use it as a way to inject momentum in some of the reforms. Remember, there has been criticism, Danny, that this is a country where oligarchs still have a lot of power. There are issues with corruption and rule of law. The numbers floated around are enormous, 100 billion euros potentially just for reconstruction damages. The overall package could go from 500 billion to 1 trillion. I've seen that number floated around too. But Danny, the reality is for a lot of the officials behind the scenes, they still continue to think, is it premature to talk about reconstruction when you don't know when the war is going to end, but also the kind of peace that Ukraine will get with Russia. And also fundamentally, if I may just very briefly, there's the other big pressing issue, and that is the short funding needs for this country. It is burning through cash, and you know very well, Danny, that wars are incredibly expensive.
Well, to that point, Maria, we've heard Europe, the U.S. at recent summits have commitments of support, but how likely is that given the economic challenges at home for these countries?
And Danny, you nailed it, because that is the tension in the story, and it's going to go in crescendo as we enter the winter. Now, we were at the G7, we were at the NATO. We asked that question multiple times. You say you will stand with Ukraine for the full run. You will be the country or with the country, whatever it takes. But how long is whatever it takes? We're now seeing the economic repercussions of this. There was a note last week, I'm sure you saw it, from Deutsche Bank Research that said we're now becoming increasingly concerned about the energy picture for Europe. The market is beginning to price in that at one point gas flows will be cut off by Russia, and the economic on this could drop immediately like a bomb on the European economy when it comes to the German industry, but also the Italian industry. Olaf Scholz, by the way, again, to answer your question, warning over the weekend that the impact of all of this could be a tremendous social crisis too. So there's a lot to factor and jiggle with for European leaders.
Maria, thank you very much. Bloomberg's Maria Tadeo in Switzerland. Coming up, crypto shakeup. FTX has signed an option to buy lender BlockFi. We're going to hear from FTX CEO Sam Bankman-Fried next. This is Bloomberg. Welcome back to Bloomberg Surveillance, the early edition. Some breaking lines. A Bloomberg scoop: Credit Suisse cutting dozens in their Asia investment bank. This is going to be across trading and deal making, according to people familiar. More cost cuts also might be to come in the fourth quarter, so we'll continue watching that story to you. Now to the crypto market, where FTX, the crypto exchange co-founded by billionaire Sam Bankman-Fried, has agreed to inject capital into BlockFi. That's a deal that includes an option to purchase the crypto lender for as much as $240 million. We spoke to Bankman-Fried in an exclusive interview ahead of the deal's announcement.
There are synergies between the businesses. I think, if you look at what BlockFi has built out, I think they have a loyal customer base. I think, they have a real business model. They have a card program that people love. They have a strong, they have strong leadership. And I think that we have been focusing on a lot of the back end infrastructure, right? On, everything from the exchange, the matching engine, risk engine, and everything else. And those match up somewhat nicely. And so I think that there are a lot of ways that our products can work together and can mesh together in a way that's sort of better than, either would be independently. And I will also say that, they've been working really productively with regulators on, building out regulated yield products and licensed yield products, which we're excited about and excited that they've been doing it in a regulated way. I think that's a healthy way to do it. And I think that's going to serve them well, long term. And it's something that, we're excited to work with as well.
You had told Politico that FTX is looking for opportunities to bail out, places where customers would otherwise be underwater. But are you worried here about moral hazard at all? That bailing out a company may not actually be what's best for the industry at large?
It's a good question. And, and I'm guessing what you're getting at there is like, does that bail out a company that really should have failed and teach sort of the wrong lesson to that company? And I think what I would say, there's two things. First of all, I'm way more excited to bail out customers than shareholders, right? And so the focus of this is not how do we deliver as much shareholder value to troubled assets as possible, right? It's how do we protect customers? And I think those imply pretty different things. So that's one thing that I'll say, and I think that one of them is way more important for the ecosystem, and the other is the one that has the biggest moral hazard. The other thing is that we are trying to find who were the responsible players who were building out a good business, had a sustainable model, and could use short-term liquidity. And that could help protect customer funds, built a real valuable business that I think had something real to offer to customers, rather than which companies honestly should never have existed, probably. And as of today, maybe we should just let them sort of die a quiet death. I do think that's something that we have been thinking about.
The FTX co-founder and CEO there. Now, as we close out the hour, quick check on palm oil falling nearly 9%. Indonesia upping its exports. That follows a ban in prior months. Producers now exporting at a rate of 7 times. Really shows the volatility in this commodity market. More Bloomberg to come.